Tax season can be stressful for many business owners, but for limited liability companies, it can also be an opportunity to receive a tax refund. However, the rules and regulations surrounding tax rebates can seem even more confusing. Understanding whether your company qualifies for a tax refund is crucial in maximizing your financial resources and improving your bottom line. In this video, we will explore how LLCs are taxed and their qualifications for receiving a tax refund. We will cover everything from what an LLC is to the specific requirements needed to claim a refund. By the end of this video, you will have a better insight into how to take advantage of potential tax refunds for LLCs. Alright, so let's begin with the video. An LLC is a type of business structure that combines elements of partnerships and corporations. It offers liability protection to its owners with much simpler tax obligations. Unlike corporations, LLC's tax rates are more flexible, as owners can choose how they want to be taxed. This means that LLC owners can choose either pass-through or corporate taxation. Pass-through taxation is the most common form of taxation for LLCs. It works by passing through the business's profits and losses to its owners. This means an LLC does not pay taxes on its income. The profits or losses are reported on each owner's personal tax return. This can result in significant tax savings for small businesses, as they are only taxed once at the individual level. If you are the sole owner of your business, your company will be considered a single-member LLC. The profits or losses from your business will flow through to your personal income tax return, and you will pay taxes based on your tax rate. If your business has partners or co-owners, your company will be classified as a multi-member LLC. The partnership does not pay taxes. Each member's share of profits or losses is reported on their Schedule K-1 form. Although it is less common for an LLC to elect corporate taxation, some companies may benefit from this structure depending on their size and profit margins. Under corporate taxation, an LLC is treated as a separate entity from its owners and therefore is subject to corporate income tax rates. This can be advantageous for businesses that have significant profits and want to reinvest in their company rather than distribute them among the owners. However, it's important to note that any profits distributed to shareholders will also be subject to individual income tax at the personal level, leading to double taxation. While most LLC members report their share of profits or losses on their personal income taxes, there are certain circumstances where an LLC may qualify for a tax refund. For example, when an LLC has overpaid its estimated taxes throughout the year or has incurred significant losses in its first few years of operation. In that case, it may be eligible for a refund. Only profitable LLCs can claim a tax refund. Another misconception is that only profitable LLCs can claim a tax refund. While it may seem counterintuitive, even businesses with losses can qualify for a refund if they meet specific criteria. If your company has incurred NOL, you may be able to carry these losses back or forward to offset taxable income from other years and potentially receive a refund. For single-member LLCs, any profit or loss from the business will be reported on Schedule C as part of the individual's personal income tax return. Therefore, the individual owner will receive a tax refund for the LLC. However, for multi-member LLCs, they will be distributed among all members based on their profit-sharing percentages outlined in the operating agreement. Alright, so I believe that's pretty much for this video. If you find it helpful, consider subscribing and giving this big thumbs up. And I'll catch you in the next one. Thanks.